Hello investors, welcome to this video series on mistakes in investing. Today, we will be talking about one of the most common mistakes that retail investors commit, and it is probably the biggest reason why many investors exit the stock market thinking that it is gambling. Today's topic is selling winners early and holding losers for too long. We will also try to understand some behavioral biases along the way that will help us figure out our own human behavior and how we can control our emotions to become better investors. So let's get started. A lot of investors, not just retail, but seasoned professionals as well, including me, are guilty of this bias, where we tend to sell our winning stocks too soon and hold on to our losers for too long. This is called disposition effect. Legendary fund manager Peter Lynch too has written about this in his book, and he says selling your winners and holding on to your losers is like cutting the flowers and watering the weeds. Today we will try to understand reasons for this kind of behavior and explore how we can go about controlling our emotions to avoid this mistake going forward. Although we'd like to think that we are rational decision makers, but we suffer from our own biases, which arise because of our emotions and our errors in judgment. There are two very strong biases that are responsible for disposition effect. One is the loss aversion bias, and the second is the risk aversion bias. In loss aversion bias, the pain of losing money is psychologically twice as powerful as the pleasure of gaining money. Simply put, the pain of losing 200 rupees is much higher than the pleasure of gaining 200 rupees. It is because of loss aversion bias that people avoid booking losses and tend to hold on to their losers for much longer than they should be holding logically. Eventually, once they are deep in loss, they also tend to take higher risk to recoup their losses. For example, a lot of investors average their position in loss-making stocks and hence end up allocating good money towards bad investments, hoping that the price will regain to its original level eventually. Let us look at some examples. Investors who invested in companies like Syntex Industries, Yes Bank, DHFL, while the stock price was going down, hoping that it would regain sometime in the future, have exhibited loss aversion bias. Some of these investors took even higher risk and averaged their position as the stock was going down, ultimately facing permanent loss of capital. So a loss-averse investor ends up taking higher risk in his portfolio just to avoid the pain of booking losses. The second bias is risk aversion bias, where people shy away from activities that have uncertainty or high risk involved. These are individuals who dislike risk and hence avoid risky decisions. It is because of risk-averse bias that people tend to sell their winning stocks and book gains too soon. They would rather book their profits than face uncertainty of the future and the risk of stock price going down, wiping away all of their profits. Net overall effect of both of these biases is that we have smaller gains and larger losses, and that pushes investors to take higher amount of risk to recoup their losses, eventually pushing them to make bad investment choices. Let us look at some examples now. Investors who invested in companies like HDFC, Kotak, Asian Paints, Infosys, TCS, and sold these stocks quite early in their investing journey have exhibited risk-averse bias. Time and again, retail investors go through this journey, and this is a very common, especially among the first-time investors. The idea of discussing these biases is to first of all acknowledge and accept that we suffer from such behavioral issues. The second is to be mindful of these biases when we are making future investment decisions. If we can understand our thought process and reduce our biases, we can be much better decision makers. And hence it is for this reason it is said that EQ is more important than IQ in the stock markets. Now let us get one level deeper into these biases and understand why do we have them in the first place? Why are we not rational decision makers? The first is mental accounting. We create mental accounts in our portfolio for each of the stocks that we invest in isolation and attach emotions to these accounts. Later, when these accounts are in loss, we have trouble closing these mental accounts. As a result, we are more likely to write the loss-making accounts for too long. The second biggest reason is regret and pride, and both of these are very powerful emotions. A loss-averse investor wants to avoid regret, and he is probably thinking, what if I sell the stock and it starts to go up from here? On the other hand, a risk-averse investor wants to protect his pride, and he is probably thinking, what if I keep holding the stock and the price starts going down from here? These are the two important reasons for our biases, and it is very important to understand them in order to be able to deal with these biases. Now, having understood both of these biases, how can we make better decisions going forward and reduce the impact on our decision making? The first is that we should look at our portfolio comprehensively and avoid making separate mental accounts for each stock in the portfolio. Objective should be to minimize our losses. Like it or not, there will be stocks in your portfolio that will underperform and few that will do very well. We should let the winners run and grow and cut investments that are continuing to underperform. The second that we need to do is to have a clear-cut reason to sell the stock. Just like we have reasons to buy a stock, we should also have reasons to sell a stock and should actually sell them when those reasons occur. The reason could be as simple as a bad news about the corporate governance of the company or a sell rating from an analyst. The third way to improve our decision making is to simply accept our mistakes and book your losses. Hoping that your losses will turn into profits one day is not a strategy that you can depend on. And as an investor, you have to have a very strong logical reasoning to hold a loss-making position. So these are the three ways we can improve on our decision making and ultimately be able to hold our gainers for long and to sell our losses early in our investing journey and not the other way around. Thanks a lot friends for watching this video today. If you like the content, please share it with your friends and like and subscribe for more such content in the future.